Good evening, everyone. I'd like to welcome you to our 2020 Information Seminar. It's a pity we can't meet in person this year, but we welcome the opportunity to engage with you virtually. We're delighted with the level of interest in the event, with over 300 attendees registered. We have two purposes this evening. Firstly, from our perspective, to provide some regulatory updates to you, including on our upcoming publications and regulatory framework changes. And secondly, from your perspective, to consider the impact of the COVID-19 pandemic on credit unions, including what you should be prioritizing in terms of responding to it. Clearly, 2020 has been a challenging year for credit unions, both operationally and financially. I'd like to take this opportunity to commend all of you for the hard work put in over 2020. To have ensured that your members were able to continue to access their credit union services has been commendable, and it's been so central to their lives. While credit unions have been effective in maintaining the continuity of services, it's important that this does not distract from the broader strategic and commercial challenge that faces credit unions. We will shortly publish our 7th edition of the Financial Conditions of Credit Unions. The data and trends set out in the report reflect well-known challenges that credit unions have faced for many years, challenges that are accentuated by COVID-19. Continued decline in annual surpluses across the sector is a notable feature in the report. This declining trend confirms the ongoing threat of sustainability across the sector. Boards must remain cognizant of future viability as they approach capital planning. They must ensure they maintain sufficient capital reserves to protect member savings, in particular in the context of their year-end decision-making. The most striking feature of the report trends is the growing gap between savings and loans. We expect you'll be very concerned about the implications of the gap for the sustainability of your credit union. Boards must focus on the risks that flow from balance sheet imbalances. Managing savings inflows and lending is a core part of the broader commercial challenge for credit unions today, in terms of successfully intermediating between members as savers and members as borrowers. Lending is the primary driver of income. Putting member savings to productive economic use in terms of the provision of credit to members should be your priority. It is one of the primary purposes of a credit union and will enable you to better balance savings versus loans. This is fundamental to our broader recovery and to your sustainability. Some in the sector point to regulatory changes as the answer to commercial challenges. They offer proposals that would place additional risk on members, for instance, by seeking to deliver sustainability through the pursuit of increased investment returns that would expose members' funds to undue risk, or equally, seeking a reduction in minimum capital requirements as savings continue to grow, increasing the risk to members' funds. Commercial challenges are addressed with commercial solutions, not greater member risks. Therefore, we urge credit unions to focus on their commercial challenges and to prudently lend to members to support their needs. As thoughts turn to recovery in the economy and in our communities across the country, now is the time to focus on prudently evolving the business model by using the lending capacity provided in our 2020 lending regulations. This will best serve members' interests, and it offers the right path towards managing your commercial challenges. We welcome the recent publication of the CEO Forum's workstream materials. These publications are a very timely contribution to credit union business model development in what has been a very challenging time for the business model. Congratulations are due to the chair of the forum, Donal McKillop, and the steering group CEOs for the progress they have made. In the Registry, we're very pleased to have initiated the Independent CEO Forum in 2018. We welcome the recent review of the forum led by the steering group. Following that review, and as planned, we're stepping back from our secretariat role on the forum. But as regulator, we look forward to continuing to engage with the forum and the CEOs involved. And we do encourage those participating CEOs to continue to drive the forum forward and to show leadership on behalf of the sector, which is a very important form of sector collaboration. Collaboration has been an important feature of 2020. While cooperation was central to support networks such as the MEHL approach that helped deliver business continuity in 2020. Given rising viability concerns, there's also a need for a greater sense of commercial urgency and strategic coherence coming from the sector. Collaboration amongst credit unions can help this. In the regulatory framework area, 2020 has been yet another busy year of change, following on from the very significant regulatory framework reviews in the last 3 years. Key framework developments I would highlight this year are firstly, a Brexit-related transitional arrangement for UK-based investments, which will apply from January 2021, should credit union boards to decide to retain such investments. Secondly, our 2020 review of the 2016 savings framework changes. We recently decided to retain the existing 100k regulatory savings limit. This reflects the lack of funding need for credit unions and the importance of protecting members' funds. Reflecting on all the recent framework changes in the last number of years, our expectation is that the flow of regulatory framework change will and must slow. Instead, credit unions should be focused on addressing their commercial challenges in 2021 by availing of the lending and investment capacity already provided, which remains largely unutilised. Other than regulatory change, what will be our focus in 2021? Next year, we'll continue to support and indeed challenge credit unions through our supervisory engagements, through our sector publications, through our work supporting sector restructuring, and through our regulatory input into your business model development. Back to tonight, we're planning to cover a range of interesting regulatory and supervisory topics. David Lynch will kick off on our supervisory expectations for your risk management and on loan forbearance. Anna-Marie Finnegan will cover the 2020 year-end process and 2020 AGMs. Colm Henry and John Marr will update on changes to the lending framework and related risk considerations. Eamon Clark will address sector restructuring. Anna-Marie Finnegan will look at Brexit preparedness and transitional arrangements for investments. And finally, Elaine Byrne will provide some closing remarks. But for now, I hope you find our seminar worthwhile and informative, and I'll hand you over to David Lynch for the first topic. Thank you for listening.
Thanks, Patrick. Good evening, everyone. The current challenging operating environment for credit unions, including both current and emerging risks from Brexit and the COVID-19 pandemic environment, highlights the importance of having a robust risk management framework which aligns with the Registry's vision for the sector, strong credit unions in safe hands. The effective management of risks is an integral part of the protection of member funds, in particular now given the uncertain economic environment. Whilst the area of risk management is broad, I will briefly focus on the importance of embedding risk management frameworks in credit union strategy formulation and operations, systems of control framework, supervisory expectations of an effective risk management framework, and an update on COVID-19 loan forbearance. On the 8th of September 2020, the Registry issued its fourth PRISM Supervisory Commentary publication, which I hope you all have had an opportunity to review. The PRISM Supervisory Commentary documents evidence-based findings across PRISM risk categories, including governance, which is aimed at supporting boards and management teams in reviewing and embedding improved risk management frameworks. The Registry is encouraged to see some examples of effective governance, including boards demonstrating ownership of risk management. However, it is a source of concern that the Registry continue to identify recurring types of risk issues, including some fundamental risk issues, which evidences a lack of significant progress in the evolution of core foundations across governance, risk management, and operational capabilities in some credit unions. This next slide relates to the Board of Directors taking ownership and oversight of risk management to assist in meeting their legislative and regulatory obligations. The importance of credit unions embedding an effective three lines of defence framework cannot be overstated. It is critical to enable the provision of oversight and assurance to the Board of Directors. The Board of Directors need to ensure that the risk management and compliance functions are appropriately resourced and supported in order to be able to carry out their functions, having regard to the nature, scale, complexity, and risk profile of the credit union. An embedded culture of risk management is required rather than a tick box approach. The Board, in the formulation of a coherent strategic plan and an appropriate risk appetite, should utilise and actively engage with its risk management framework. I am aware of credit unions who convene strategy away days to facilitate the development of strategic initiatives, which is to be welcomed. But there appears to be an absence of active risk management and involvement in some of these strategy formulation events. Insufficiently detailed risk management and compliance reporting to the Board of Directors was identified in some supervisory engagements undertaken in 2019. The effective use of risk management information, including key risk indicators, can assist the Board of Directors in effectively undertaking its non-executive roles in making informed decisions and taking appropriate actions where necessary. The next slide. The development and embedding of an effective systems of control framework is an integral part of robust risk management. Credit unions are reminded of the 2020 financial year-end circular issued on the 4th of September, which included the Registry's supervisory expectations on a number of matters, including systems of control. Whilst the Registry acknowledged the unprecedented challenges which your credit unions have faced given the operating environment over recent months, your credit unions need to be vigilant regarding the potential vulnerabilities in IT systems, in particular arising from cyber risks, and ensure on an ongoing basis that credit unions have strong and robust systems of controls in place to maintain ongoing compliance with Section 76G of the Credit Union Act, which talks to information systems. Arising from the ongoing supervisory engagement with credit unions in the COVID-19 environment, the Registry is aware that some credit unions have extended their processes to facilitate remote working and/or remote access to member services, which need to be reassessed and associated operational risks identified and managed. As part of our supervisory engagements, the Registry continues to find failings in internal controls, including deficiencies in systems of control related to bank and cash management and inadequate segregation of duties. Credit unions should have appropriate oversight and supervision of cash management processes, including preventative and detective controls, to minimise and mitigate the risk of misappropriation of credit union funds. I would encourage credit unions to review the Credit Union Handbook, which is accessible on the Central Bank website, to ascertain further guidance on an effective internal control framework. This next slide summarises the Registry Supervisory's expectations in relation to risk management. It is strongly encouraged that credit unions consider all of the evidence-based weaknesses in the PRISM supervisory publication, how they may relate to your business and where they arise, to implement on a timely basis the necessary changes to mitigate these risk issues. Credit unions shall ensure that they have adequately resourced risk management functions, sufficiently detailed risk management and compliance reports, which enable the board and management team to be made aware of risks and enable the execution of appropriate risk mitigants to address such risks, and the policies and practices in place are aligned and consistent to the board-approved risk appetite. In addition to our ongoing bilateral supervisory engagement with individual credit unions, the Registry are also considering how a thematic review may support credit unions in addressing recurring RMP risks. The objective of undertaking a thematic review on the topic of risk management would be to see evidence of improvements in risk management frameworks and governance culture within credit unions. And finally, an update on loan forbearance. As you are aware, the Registry have engaged directly with all credit unions since April 2020 to gather specific information in relation to member requests for modification of loan repayments in the context of COVID-19. I take this opportunity to thank you for engaging constructively with the Registry on this important work. Based on data submissions to date, the overall level of forbearance requests by number and by value is not substantial in the context of total credit union sector lending, less than 1% of gross loans outstanding. The Registry will continue to monitor these trends through analysis of the monthly submissions and relevant follow-up engagement to understand the level and impact on the financial resilience of individual credit unions. As your credit unions will be aware, on the 8th of June, a circular was issued in relation to payment breaks, which set out details on this key area for credit unions, including from both a member protection and prudential perspective, and articulation of the Registry's related supervisory expectations. In terms of the overall approach in dealing with loan flexibility requests, the Central Bank expects credit unions to act in a way that protects the best interests of borrowers and gives appropriate support to borrowers whose incomes and affordability have been affected by COVID-19. When considering such requests from a prudential perspective, Board of Directors should take account of areas outlined in the circular. Some of these include the relevant regulatory framework requirements, the financial position of the credit union, the level of distress in loan books should be prudently considered and be reflected in provisioning levels, and effective and efficient management of distressed loans is important to protect reserves of your credit unions, which are not unlimited. Thank you. My colleague Anna Marie will now present on 2020 year-end related matters.
Good evening, everyone. Just checking that people can hear before I start off.
Yep, you're fine, I'm right.
Thanks, Jennifer.
Yes.
Thank you. Thanks, David, for that presentation. And as I say, good evening, everyone. I'm now going to give a short presentation on the 2020 financial year end and a look at 2020 AGMs. So I'm going to give a very quick recap on the key messages set out in our circular. I'm going to give an update on the year-end process that is in progress. I'm then going to give just a quick overview on some key financial figures. And then I'll talk about 2020 AGMs and give an update on the Finance Miscellaneous Provisions Bill, which was published on the 18th of November. So I'll move now to the next slide. So as you're aware, we issued a year-end circular early in September, and as David has already touched on, this highlighted a number of key issues and expectations around the 2020 year-end process. And I set out some of the key messages on the slide, and they relate to loan provisioning, the maintenance and building of reserves and systems and controls, which David has already touched on. And I suppose one of the key messages for 2020 is that the year-end process needs to be informed by the challenges that credit unions face. And these include the challenges presented by COVID-19 and indeed Brexit. And that boards need to take a prudent approach to reserve management given the uncertainty in the economic outlook. So I'm just going to give a quick update on the next slide on the year-end process. So at this stage, we've received about 118 draft financial statements. So that's as of the 1st of December, representing about half of credit unions. So this compares with a return rate of about 71% for this point last year. And I suppose we'd like to take the opportunity to thank credit unions who have engaged with us and have already submitted financial statements, and to encourage other credit unions to continue to focus on timely preparation and audit of the 2020 accounts. And as we set out in the circular, it's important that the financial position of the credit union is finalised and audited and therefore available to inform board and management decision making, and also so that it is available to be presented to members as appropriate. So I'm now just going to give some high level data just in terms of some comparisons between 2019 and 2020 data. And I've just put up some figures on the slide there. I'm not going to go through them all. I suppose these highlight some of the issues and challenges that Patrick mentioned in his opening remarks. So I suppose that they're of interest. And just also to mention that there will be additional data provided in the upcoming financial conditions publication. So this is due to be published in the coming week and will provide additional data and information on trends. And I think this will be useful in providing data to inform strategic discussions at an individual credit union level. So moving now to look at 2020 AGMs, and just by way of background, the 97 Act includes a number of provisions relating to general meetings or annual general meetings, and you'll be familiar with those. I suppose I'd just point out the requirement for AGMs to be held in the state and at a time and place provided for under credit union rules. I'll move now to the next slide. I just thought it was useful in the context of the challenges associated with 2020 AGMs to recap on some of the key purposes for AGMs, and I've set these out on the slide here. So these would include the provision of information to members on the financial position of the credit union, and also member participation in key decisions. So ensuring that elections of new board members can proceed, and also seeking member ratification on key decisions, including those around transfers and engagements, provision of new services and common bond extensions. So the next slide focuses on, I suppose, the challenges associated with holding AGMs in 2020. And traditionally, AGMs have been held in physical locations, and votes have been cast by members who are in attendance at AGMs. And in light of COVID restrictions, consideration has been given to alternative options for holding virtual or remote AGMs. However, there was a level of uncertainty as to whether this could be done within the requirements of the 1997 Act. And I suppose this related to the fact that virtual AGMs would not have been contemplated when the 97 Act was being drafted and enacted. And also the reference to a place in the 97 Act, I think, would most likely be interpreted as a reference to a physical place. And I suppose our view in the registry on this was that it was important that AGMs could proceed in line with legal provisions while also meeting public health measures, and that legal clarity was required. So moving now just to talk about the Finance Miscellaneous Provision Bill. So following engagement between the Department of Finance, the Central Bank and sector representative bodies, this bill has now been published. It was published on the 18th of November. The bill and explanatory notes are available on the Oireachtas website, and I've provided a link there that will be in the slides when they're circulated. On my next slide, I've just set out some of the provisions that are included in the bill. So the bill introduces amendments to the 97 Act, which are designed to facilitate remote or partially remote AGMs. A couple, I suppose, of key features are the extension to the deadline for AGMs. So this is now moved to the end of the interim period, and the interim period runs from the date of enactment of the bill up until the 30th of April 2021. As I mentioned, the bill allows credit unions at their discretion to host general meetings remotely, either wholly or partially. And the bill deals with the holding of AGMs both during the interim period and then beyond the interim period. And I think the key distinction there is that during the interim period, an AGM or a general meeting can be held remotely, notwithstanding this not being provided for in the rules of the credit union. So it doesn't require a change to the rules. And while credit unions can continue to hold AGMs remotely after the interim period, it would need to be provided for in the rules for that to happen. And I've just mentioned electronic voting, which is permitted both in the interim period and outside the interim period. Over on the next slide, just some additional provisions. So directors are permitted to cancel, relocate or change the means of a general meeting where necessary. There's also some provisions around providing information and notices to credit unions, and also provisions in relation to permitting proxy voting, which is subject to certain requirements and must be provided for within the rules of a credit union. So just a final comment before I finish, just in terms of timelines. When the press release was issued by the department, it was indicated that this would be a priority for enactment by the DAL before the end of the year. But just as was noted at that stage, that would be dependent on timelines around the DAL process. So that's the end of my presentation, and I'll hand you on now to John and Colin. Thanks for your attention.
Thanks, Anna Marie. Can you hear me okay?
Yep, I can, yeah.
Perfect. Thanks very much, and good evening to everyone. My name is Colin Henry, and I work on the Policy Assurance and Regulatory Approvals team in the Registry. Together with my colleague John Maher, I'm going to give you a brief update on the recent lending framework changes that came into effect earlier this year. We will also highlight some key points on risk considerations for credit unions seeking to become more involved in longer-term lending. So first, I will provide a recap on the recent changes to the lending framework. As you may recall, the review of the lending framework commenced in early 2018. On 24th of October 2018, a consultation paper, CP125, was published. And in that, we listed the objectives of the review, namely to ensure that an appropriate lending framework for credit unions remains in place, which facilitates growth in loan-to-asset ratios on a gradual basis, facilitates development of balanced loan portfolios to underpin sustainable income generation, avoids inappropriate levels of duration risk and concentration risk, and appropriately considers asset and liability management, or ALM, risk. The review was informed by sector engagements, a formal request received from the CUAC Implementation Group to review the Section 35 lending limits, lending sector data and trends, the domestic lending landscape, the existing lending framework, and broader balance sheet considerations, including in relation to ALM. Following the public consultation process, consideration of stakeholder feedback, and a statutory consultation process, we published our feedback statement on CP 125 and final draft amending regulations late last year in November. On the next slide, I have highlighted the final changes to the lending framework. They include the removal of the 5 and 10-year lending maturity limits, which were based on the percentage of outstanding loans, new combined concentration limits for house and business lending on a tiered basis and expressed as a percentage of total loans. These include a 7.5% limit for all credit unions, a 10% limit for credit unions with assets of at least €50 million, and regulatory reserves of at least 12.5%, and an increased 15% limit for credit unions with assets of at least €100 million, subject to an application process. The introduction of a maximum loan maturity of 10 years for unsecured loans and the extension of the maximum loan maturity for secured loans, so from the previous 25 years to 30 years now. Other changes are set out on the slide and include renaming and redefining the commercial loan category of lending. That's now the business loan category, and rescinding the Section 35 requirements. The final changes came into effect on the 1st of January 2020. On the next slide here, this highlights some of the key messages following the review. The suite of changes followed a comprehensive review of the lending framework. The revised lending regulations allow credit unions to undertake increased longer-term lending to support increased diversification. Further additional capacity is now available for larger, stronger credit unions who meet certain requirements. It's important to note, of course, that credit unions wishing to undertake increased house and business lending understand the risks involved, and my colleague John will address this topic shortly. The revised lending regulations represent significant and fundamental structural changes to the framework and provide sufficient capacity and flexibility to enable safe and sound business model transformation on a sustainable basis. Where conditions in the sector are such that there's an evidence basis to adjust capacity in the future, this could be achieved by amending the level of the limits. On the next slide, it simply shows a timeline overview of our review of the lending framework. I would add this that in May 2020, we published an application form for the increased 15% limit and an associated guidance note, which I will address on the next slide. This slide sets out some information on the 15% limit, in particular on the application process. Credit unions with total assets of at least 100 million for 2 or more consecutive quarters can apply to the Central Bank for the increased 15% limit. In order to grant approval for the limit, the Central Bank must be satisfied that the credit union has demonstrated that the approval would be consistent with the adequate protection of savings of members, and that it would be effective and proportionate having regard to the nature, scale and complexity of the credit union. As set out in the regulations, the Central Bank will also consider the total realised reserve position of the credit union. A credit union seeking to avail of the 15% limit must complete an application form, have it approved by the board and signed by the chair, and submit it and the relevant supporting documentation to the central bank. The two formal stages of the application process are stage 1, submission of a completed application and the assessment of the application by the central bank, and stage 2, the approval refusal stage. In advance of submitting a completed application form, we would recommend that credit unions discuss the proposed application with their supervisor in the registry. The supervisor may be in a position to identify issues that the credit union should address prior to completing and submitting an application. On this next slide, it just identifies some useful resources we have published on our website on the topic. With that, I will hand you over to John Maher. Thank you.
Hi, thanks a lot, Colm. Hopefully, am I being picked up there okay? Yep. Okay, all right. Again, thanks, Colm. I just want to take a few minutes, everybody, to outline for the expectations of the registry in terms of applications and submissions for the enhanced limits. I know the 15% being the enhanced limit. However, I would stress that I think that the principles apply to all credit unions, given that even the base limit is a considerable increase in capacity from previous regulations. And I think that's even important. So it is important, I think, to all credit unions, regardless of size, given the capacity. So I'll also then just maybe point to some particular guidance and guidelines that exist that maybe I think you'll find useful in terms of looking at it, even expanding your presence in-house or business lending. So maybe on the next slide, if I can have that, please. Yeah, okay, sorry, I'm one ahead on here. I'm looking at another screen. So if I just go back one, thanks a lot, Jed. Yeah, I think just grouped it under two headings, we would be very anxious that credit unions take an approach, and I've classified it under the headings of demonstrate and illustrate. And I suppose under the demonstration heading, we'd very much want credit unions to understand the new concentration limits and how they operate alongside one another. They are linked to total assets, so it's very different from the previous, 10 to 15% or 30 to 40%. And then it also flexes with total asset growth, and I think that's important as well because the impact of loan repayments also, and then obviously growth in total assets. So understanding the limits, the new limits, is obviously important. I think the relevant regulatory frameworks then that house lending and business lending operate under is also critical. There's quite an amount of regulation associated with that, and a lot of this is consumer and is consumer led, and it is mandatory and is constantly changing based on either European directives that are come down and are transposed, or else on domestic legislation. So understanding of that is obviously critical. Also then, I think it would be important to be able to demonstrate that the expansion into these areas is consistent with business model positioning as reflected in the strategic plan. So I think the logical link then is to the illustration that would be expected as part of the submission. I think it's very much around the being able to show how you see this impacting on your business over the relevant timeframes. In many of the cases, this will be a significant growth in particular business categories, maybe where there wasn't a significant emphasis previously. So actually the building of the business and the growth over time and the impact on revenue and expenditure line, on balance sheets is absolutely critical. So from our point of view, seeing that documented and outlined in detail, in the first instance, we believe is absolutely critical for the credit union itself. So rather than seeing this as an additional workload on the part of the credit union, we see this as absolutely essential for internal management, measurement and monitoring as you go, a roadmap of sorts. And the detail in this case is quite critical, obviously, given the nature of the business loan, the nature of mortgage loans, the sort of typical loan size, typical activity behind that, and the risks that come with that, risks in relation to conduct, regulatory risk, reputational risk. These are key areas and from a consumer point of view, a house loan is, typically, the largest, investment that they will make, and obviously associated loans. So it's pretty critical in all respects, obviously as part of that chain, that the credit union is in a position to meet its obligations on all sides because of obviously the implications of not getting it correct. So, and I would stress that the issue there is very much in relation to detail. And obviously the supporting policies, in particular, say the credit policy is, essential in that respect. So the documentation of that and the nature of that and the, I suppose, the clarity and the unambiguous nature of that in relation to how you intend to operate these businesses. Obviously, the opposite of that is that a lack of clarity or transparency in these, I don't think it serves, staff members, be it lending officers. I don't think it serves the members, the borrowers, and I think it makes for a much, a much simpler and implementable plan in all respects. So that's really just a couple of, I suppose, pointers. On the next slide, I would really just point out to a particular document that we believe is useful in this respect, and it is the guidance in relation to long-term lending. It's a number of years, it's late 2017 it issued. I have gone through it in recent days. I believe it's as relevant now in terms of the principles, and goes through the primary risk considerations, and I'd recommend it from the point of view of hopefully a practical guide in terms of guiding you in relation to preparation, not just of the application, but as I said, actually of the actual business planning in relation to expanding your business in these particular areas. And then final slide, I would just make a particular point in relation to the whole area of new product and service development. Obviously getting involved in business lending where maybe there was previous no business lending or very minor exposure to it, and likewise house lending, is it's a significant development, and the EBA guidelines there, the European Banking Authority guidelines, I would point to in particular there in relation to the product oversight and governance, I think represent a very useful and practical guide, and they're easily accessed by typing in the EBA/GL 2015-18 guidelines. They're very much consumer-led from the point of view of consumer protection, and that's would be very typical of European legislation and directives insofar as they actually end up being transposed down into Irish regulations and Irish law. And I think particularly the whole issue about product oversight and product design in particular is critical. The issues that we've had in recent years, nationally in relation to flaws in product design and flaws in what happens, for example, in things like tracker mortgages, and that you can see the sort of consumer detriment that arose as a result, the cost to the organisations involved, and the significant reputational issues that arise from a lack of attention to detail in the whole area of product design, and that extends to the whole product oversight and governance area. So that's really all I'd have to say in respect of that. My final point, and to reiterate what Colm said earlier, is early and regular engagement with supervisors, in relation to your intentions, is very much recommended. I think you'll find it useful from the point of view of being able to and being pointed to appropriate guidance or guidelines, and I would recommend that in all respects. So that's really all I have to say, and I just wish you well in your endeavours in terms of developing your business in those particular areas, and I'll hand back to the chair in relation to that. Thanks a lot, Jim.
Jennifer, just before we start, can everybody hear me okay?
Yep, I hear you fine.
Okay, thanks. Good evening, everybody. Many thanks for the opportunity to speak with you this evening, and I hope that everybody is keeping well in these turbulent times. No doubt I've spoken with a number of you bilaterally over the years, but for those of you that I haven't spoken with before, my name is Eamon Clark, and I am the Intervention and Restructuring Team Lead. This is the team within the Registry whose responsibilities include overseeing the ongoing restructuring of the credit union sector via transfers of engagements. I intend to give a brief presentation to cover the topic of restructuring this evening. I'll interchange the use of the terms restructuring and transfers of engagement, but with the same intended meaning. In keeping with my colleagues who have already presented, I'm happy to answer any questions that you may have on restructuring in the question and answer section towards the conclusion of this evening's information seminar. With this in mind, I'd like to start, if I can, by providing an overview of restructuring. My first slide highlights some of the key features of transfers of engagements, including, firstly, transfers of engagements are voluntary in nature. The process typically, but not always, involves a lower asset size credit union, known as the transferor, taking the strategic decision to enter into transfer of engagements discussions with another credit union, known as the transferee. This decision can be taken for a host of reasons. For example, with the intention of expanding the range of services available to members. It could also be taken to address current or anticipated governance, operational or financial weaknesses and constraints within the transferring credit union. Secondly, I'd like to draw your attention to the fact that there's a central team within the registry that has responsibility for interacting with credit unions who are seeking to advance a restructuring process. Our role within this team is to facilitate and oversee the transfer process to progress viable transfers of engagements with a view to ensuring that both members of the transferee and the transferor credit union stand to yield advantages from the completion of a proposed transfer. Thirdly, as highlighted on the slide, the completion of viable restructuring projects supports the registry's vision for the sector. TOEs help to maintain and expand the provision of credit union services across the country and maintain the financial stability and well-being of credit unions generally. One of the central aims of restructuring is to maintain the longer-term availability of credit union services in common bond across the country. Further information on restructuring is available in the thematic review of restructuring published last year. The key findings of this review were between 2013 and 2019, approximately 420,000 members of transferor credit unions became members of transferee credit unions and enjoyed continued and bolstered access to credit union services. The review also found that there was not a commensurate decrease in the number of individual business locations to match the reduction of individual registered credit unions, and that indicates that the local presence of credit unions has been maintained throughout restructuring. Finally, the review noted that transferee credit unions have delivered higher loan growth than the rest of the sector and experienced a lower level of increase in operating costs by eliminating duplicated costs and achieving scale economies. Moving to the next slide. This slide provides a graphic illustration of restructuring activity in the credit union sector from 2008 to 2020. Some key points to note are, as can be seen in the table at the top of the page, restructuring has been the primary driver in the changes of the profile of asset sizes across the sector. The completion of transfers of engagements has led to the number of credit unions with asset sizes greater than 100 million, more than doubling between 2013 and 2020. Restructuring has occurred in 25 of the 26 counties, with Monaghan being the sole exception. A significant volume of restructuring has occurred in Dublin, Cork, Limerick and Galway counties. The period 2015 to 2017 witnessed the highest volume of transfer of engagement activity. This period coincided with the time that the Credit Union Restructuring Board, REBO, was active. However, in the 3-year period since the conclusion of REBO, restructuring has continued, albeit at a lesser pace. For example, to date in 2020, a total of 13 transfer of engagement processes have completed. There is a sustained level of transfer processes that are currently underway, in addition to further transfer processes that will commence in the future. Moving on to the next slide. This slide provides an overview of the typical steps and stages involved in the transfer of engagement process. These are sequential steps, with each step completed in order and subjected to review prior to the process moving to the next step. The first stage is the initiation phase, high-level business case stage. In this stage, credit unions contact RCU and indicate their intention to proceed with a TOE. RCU will then seek to meet with the credit unions in order to provide an overview on the process and establish indicative timelines. At this stage, the credit unions will be required to set out a rationale for the proposed transfer, in a high-level business case to be submitted to the registry. Following the completion of Phase 1, RCU will set out terms of reference for the asset reviews and due diligence reviews of each credit union. Asset reviews will typically require the credit unions to engage an independent third party to complete reviews of the loan book, investments, fixed assets and governance relating to assets. In the due diligence review phase, the credit unions will engage an independent third party to report on areas such as financial performance, governance, systems and controls, operation, compliance, IT, HR and legal. Assuming that all issues identified in the asset review due diligence reviews can be addressed, the transfer will then proceed to the detailed business case stage. This stage should clearly identify the benefits and synergies in the proposed transfer. It should also serve as a detailed strategic plan for the combined credit union and will include the proposed governance and management structures. Detailed business case should also be supported by financial projections, a business plan supporting the achievement of these projections, and an implementation plan for the operational execution of the transfer. Following the detailed business case stage, the transfer will move to the approval and confirmation stage. Under the 1997 Act, a member's resolution at a general meeting is the default mechanism by which a transfer of engagements is completed. Transfers can also be completed by way of board resolution in circumstances where the registrar deems that the use of expediency is warranted. Members are notified of the proposed transfer through a statement known as the Section 130 Pack, with the timing of issuance depending on whether the transfer is completed by member resolution or by board resolution. Following the passing of a resolution, the credit unions will formally apply to have the transfer approved by the registrar. This process will involve the publication of newspaper notices which notify members that representations can be made to the credit unions or the central bank within a 21-day period. Following the conclusion of the representation period and subject to consideration of any representations received, the central bank will either confirm or refuse to confirm the transfer of engagements. The final phase of the transfer process is deregistration. Upon receipt of confirmation that all property vested in the transferor credit union has been conveyed to the transferee credit union, RCU will proceed to cancel the registration of the transferor, which formally concludes the transfer process. The timeline for any transfer of engagements is dependent on factors such as the scale and complexity of the transferee and transferors, the availability of third parties to conduct the asset reviews and due diligence reviews, and the results of these reviews. Typically, the overall process can take between 6 and 12 months to complete, but this will vary depending on the individual circumstances applying. In certain circumstances where risks are particularly pronounced, the registry will work with the credit unions involved to expedite the timelines attached to the TOE process. Turning to the next slide and the conclusion of this segment of the information seminar, RCU continues to view restructuring as a key component of the future strategic direction of the credit union sector. We encourage all credit unions to give consideration to future transfer of engagement activity and whether this may be appropriate as part of delivering on the wider strategic objectives of the credit union. Depending on the circumstances of the individual credit union, this may involve acting as either transferor or transferee. As credit unions continue to assess opportunities to further develop their business model, future restructuring activity may include both the continuation of transfers of smaller asset-sized credit unions to larger asset-sized credit unions and the coming together of larger asset-sized credit unions. RCU will continue to engage with credit unions on proposed future restructuring activity to provide support and assistance insofar as is possible. We welcome the opportunity to discuss any potential transfer of engagement proposal. Please contact any of the following members of the intervention and restructuring team with any query you may have, and names and contact details are included on the slide pack that will be sent. And with that, I'd like to conclude my presentation. Thank you again for your time, and I appreciate the opportunity to speak with you during the seminar. I'll now hand you to the next presenter, which I think is Anna Marie. Thank you.
Thanks, Eamon. And just checking again that people can hear. Yeah,
Yeah, so this is the final set of slides, and there's only 3 slides left, you'll be glad to hear. And just to mention before I start speaking to the slides that we will share the slide packs with attendees after, so we will email them to credit unions after this evening's event. So the final topic of the evening is Brexit preparedness and transitional arrangements. So moving to the first slide, I suppose we wanted to take the opportunity to touch on Brexit and Brexit preparedness this evening, as it remains a key issue for sectors. There is still considerable uncertainty around Brexit and the potential impacts on the Irish economy. And in light of this, credit unions need to continue to identify, monitor and action potential Brexit-associated risks. And I suppose in this regard, we stress the need to consider credit union-specific vulnerabilities. So these might be based around the location of a credit union, specific aspects of a business model of a credit union, or characteristics of a local economy that a credit union is exposed to. So I suppose this process needs to be ongoing. I've also just set out, I suppose, some of the key Brexit-related risk considerations that we are focused on. So these relate to credit risk and I suppose ascertaining levels of credit risk and credit exposure that may be impacted by Brexit and ensuring adequate provisioning is in place. Again, that theme of the need for prudent reserve management in the context of Brexit risks. Also that focus on operational risk, which has been touched on in some of the earlier presentations. And also investment and investment risk. And I'm going to talk a little bit more about investment in the context of the transitional arrangement on my next slide. So by way of background, under the existing regulations, credit unions are currently permitted to invest in deposits and bank bonds issued by credit institutions. And for the purposes of the regulations, a credit institution is defined as an entity authorised as such under CRD. So at the end of the 12-month transitional period, based on this current definition, an investment with a UK credit institution that doesn't have an EU authorisation or hasn't sought an EU authorisation would no longer fall within the definition of a credit institution under the credit union regulations, and as such would not be in compliance with the regulations. So in order to address this issue, and this is based on engagement with stakeholders over the last year, we're introducing a transitional arrangement, and what this will do is it will permit retention of existing investments, so that's investments that credit unions currently hold in UK credit institutions that would become non-compliant post-Brexit. So it provides that for fixed-term investments, and my understanding is that will cover the majority of such investments. They can be held to maturity, and for any investments that don't have a fixed maturity date, there's a 2-year window for those to be addressed. So I'll move now to the final slide of the presentation, and this is just to give some information on some additional amendments that we will be making to the regulations. So the first of these is an amendment to the definition of relevant liquid assets. So we're amending the definition to include balances in the minimum reserve account in excess of ECB minimum reserve requirements. And this is to reflect the introduction last year of the ECB's 2-tier remuneration system. And as a result of that, credit unions are choosing to put additional liquid funds in their reserve deposit account at the central bank. And where these funds are in excess of the minimum reserve requirement, they are withdrawable by the credit union and therefore, I suppose, meet the criteria to be considered as liquid. Also, one other additional change in relation to maturity limits. So we are going to extend marginally the maturity limit for investments in state securities and supranational bonds. And the reason for that is just to ensure that credit unions aren't precluded from new issuance or primary issuance in these types of securities. We understand that sometimes when a 10-year bond is issued, it's issued with a slightly longer maturity than 10 years. So this will just cover that issue. So in terms of the process, we're currently involved in statutory consultation with the Minister, CUAC and the credit union bodies, and it is our intention that the regulations would commence before the end of the year. So that brings me to the end of the slides. I'm now going to hand back to Elaine, who is going to coordinate the Q&A if any people have any questions they'd like to address to us. Thanks very much.